So the next thing about this article is the challenges. So the first thing they explained about these challenges are an organization's management accounting system must provide timely and accurate information to control costs, measure productivity, and inform decisions on pricing, product introduction, and make in and discontinuation and managerial performance. So the next thing is it serves as a vital communication link between senior and subordinate managers and influences managerial compensation and promotion decisions. A strong management accounting system is crucial to success, while ineffective one can hinder efforts in product development, process improvement, and marketing. However, if the system is recognized and inadequate, manager may bypass it by creating their own information system. So that's all about the challenges. So the first one is opportunity. The opportunity, which this article explains about the demands for the excellence in management accounting system come at a time when information collection and processing costs have decreased thanks to advance in technology, and with many processes now under digital control, real-time information can be recorded and analyzed. So next, they talked about the automated systems and network technology allow for continual status reports, accurate measurement of resource documents, resource demands, sorry, and timely performance measures. So the last thing they mentioned about is the computing revolution has removed barriers to the design and implementation of effective management accounting system. That's all about the opportunity.
I'm Tarveen Parikasan. Hereby I would like to give a presentation on the management accounting rules and its relevant laws. So here I've prepared some Canva posters so that it can illustrate the timeline of management account, the timeline of evaluation of the management accounting and the relevance laws more efficiently, and I think it can be understood easily. So here let's get into the poster. Okay, the proponent of the economic approach argued that the management accounting practices originated from the private sector to support the business operations. For example, here Johnson and Kaplan, 1987, state that the origin of modern management accounting can be traced to the emergence of managed hierarchical enterprises in the early 19th century. So in stage one, during this period, the need to gain more efficiency in production was realized. Factory owners started hiring more workers on a long-term basis in a centralized workplace, and hence the development of hierarchical organization occurred. So factories were frequently located in a considerable distance from the head office of the owners, and an information system was required to increase and judge the efficiency of the managers and workers at the factory. Before this time, the Industrial Revolution period, the workers were hired on a short-term basis and paid on work done basis, while factories were owner managed. The role of accounting was thus limited to record keeping. So in stage 2 here, the emergence and rapid growth of railways in the mid-19th century was another major driving force in the development of management accounting system. New measures such as cost per ton per mile, cost per passenger per mile, and ratio of operating expenses to revenue were created and reported on a segmented and regional basis. These measures were subsequently adapted and extended in other business sectors. Moving on to the third stage here, Johnson and Complan state that conclude that management accounting systems evolved to manage and evaluate the efficiency of internal processes and not to measure the overall profit of the organization. Hence, a separate financial accounting is required and had to be operated to record transactions and process data for preparing annual financial statements for the owners and creditors of the firm. So, managers accounting and financial accounting should therefore operate independently of each other. And moving on to the fourth stage here, according to Drury 1996, further advances in management accounting were associated with the specific and scientific management movement. For proponents of this movement, led by Frederick Taylor, concentrated on improving the efficiency of the production process by simplifying and standardizing the operation, which in turn will improve the profitability of a company. In 1911, Charter Harrison published the first set of equations for the analysis of cost variances. By 1920, sophisticated systems to record and analyze variance from the standard had been implemented and articulated in the literature. So advances in management accounting may also be attributed to the growth of multi-activity, diversified organizations in the early 20th century. Different managers ran the firm's divisions. The role of the top management became that of coordinating the diverse activity, directing strategy, and deciding on the most profitable allocation of capital to a variety of different activities. New management accounting techniques were devised to support these activities. Budgetary planning and control systems were developed to ensure that the diverse activities of different divisions were in harmony with overall corporate goals. In addition, a measure of return on investment was devised to measure the success of each division and entire organization. System of transfer pricing were subsequently devised that sought to provide a fair basis for accounting profits between divisions. Most of the management accounting practices currently in use had been developed by 1925, and for the next years, there was a slowdown in management accounting innovation, which is stated by Johnson and Complan in 1987. During this period, external financial conventions encouraged a financial accounting mentality, resulting in management accounting following and becoming subservient to financial accounting practices. It was argued that the cost of running two systems was by then too high, and hence making it difficult for managers to run the two systems separately. Later development in management accounting may be traced in the work of Boyer in 2000. He asserts that the management accounting began under the label of cost accounting in the distant past and split from the cost accounting in the 1950s. So, a search of Harvard Business School library by Boyer in 2000 identified only 4 management accounting books that were published prior to 1960. One was published in 1953 and the rest were published after 1956. So during this period, standard costing was viewed as the key accounting tools in the cost control, and few people questions the ability of standard costing to provide effective managerial control. So according to according to Anita in 2000, Standard costing was promoted by the both academic and professional organization prior to 1970s. Cost variance, net profit, and return on investment were the primary financial measures of management performance. Relevant loss, generally, relevant loss is an overview of the evaluation. Sorry, the evolution is an overview of the evolution of management accounting. Okay, so there are four stages in the evolution of the management accounting. So the Internal Federation of Accountants identified that four stages in which management accounting has evolved. So in the first stage, prior to 1950, the focus was on the cost determination and financial control through the use of budgeting and cost accounting technologies. In stage 2, by 1965, the cost had shifted to the provision of information for management, planning, and control through the use of technologies such as decision analysis and responsibility accounting. In stage 3, by 1985, attention was focused on the reduction of waste in the resources used in business processes through the use of process analysis and cost management technologies. In stage 4, by 1995, attention had shifted to the generation of or creation of value through the effective use of resources, through the use of technologies which examine the drivers of customer value, shareholder value, and organizational innovation. It should, however, that although the four stages are recognizable, the process of change from one to another had been evolutionary. So consequently, each stage is a combination of the old and the new, with the old reshaped to fit the new in addressing a new set of conditions in the management environment. So in the first stage, management accounting is seen as a technical activity necessary for the pursuit of the organizational objectives, while in the second stage, it is seen as a management activity performing as a staff role to support line management through the provision of information for planning and control. In the third and fourth stages, management accounting is seen as an integral part of the management process. With an improved technology, information is available in real time to all levels of management. The focus therefore shifts from the provision of information to the use of available resources to create value for all the stakeholders. So that's all for now. Thank you.
So the next thing is about the academics led astray, and they explained about the failure of university-based researchers to address the obsolescence of organizations' management accounting systems was due to their narrow focus on a simple model of firm behavior influenced by economics one production process model. And the next thing is they focused on elegant process approaches to analyzing costs for single product, single process firms, neglecting the complexity of actual organizations with hundreds or thousands of products and multi-stage production processes. This led to companies relying on outdated systems and dominated by senior executives who lacked knowledge of underlying technology and relied solely on short-term financial measures for decision making. As life cycles shorten and more costs are incurred in production, traditional measure traditional financial measures become less useful. So the academics failed to address this issue also. That's all for this academics led ashtray. Thank you.
Hi, my name is Tharmin, and I will be talking about accounting for caravans and innovation. In this article, the writer emphasizes on the historical track of management accounting to show that the thing that we have been discussing earlier on this presentation was not a new phenomenon. It started back in 15th century since the publication of the famous original book by Parafascioli, who is an Italian. It is basically about the early days of trading goods in Venice, Italy with other countries. The standard back then was not as complete and thorough as what we have today. We may have noticed few distinctions of how we can account certain items. The traders from Venice gained goods from the northern Italy and sell them in India. Once they were all sold, they went back to Italy while bringing back some tea stocks for them to be traded in Venice. So, in order to calculate the profit gain, the accountant back then decided that they had to subtract the cost of caravan and other initial acquisition costs in order to find profit figure before dividing them between investors. However, the question that came to me is that for the modern view, were there any regulation to compute the quarterly report of the expedition in the particular year, which was 1487? People back then spent a lot of time traveling across continents, especially in this article. It says in the third quarter, where the traders had traveled across the Persian desert. To take them into consideration, everything was at slow pace back then. They commuted from one place to another, and it consumed a longer time than we have today. For them to calculate profit for expedition is that particular in that particular 3 month is not worth it at all, and is not meaningful exercise, but somehow in today's world it is already easy to prepare monthly and quarterly report. Not to say that this method is arguably meaningless to see the short-term progress, but as we coming back to the Venetian story, they actually could do the monthly enquiry report, but they didn't do so. They had many potential methods which would distinct about the condition of inventory being transported, the amount of provision left, and many more. Why didn't they think of any of it? Think about it. To take into this point of view, there were actually many better indicators to see in the short-term progress of an organization rather than depend on quarterly earnings. Cash flow is actually important to see the patterns of cash with cash receipts and also cash expense. But they are relatively different than working hard to produce the quarterly income statement because of the amortization and any other equal as according to the article. Lastly, I'm going to talk about innovation. In this article, the management accounting should have robust changes to make it relevant over time. The system is said to be designed to supportive with the business operation and strategy for better financial forecast. How do we do that? According to the article, it can be done by effective experimentation and communication, where we may find the solution due to better enrichment. Other than that, we can also have creative managers and academic researchers to develop new concept of management accounting system that we might never think about it. Does this management accounting method of short term will remain relevant in the future, or does it really help to see the performance of organization only? With that quarterly report, if there is a little to no further to this action, we most likely fail to show the actual or more accurate financial information in decision making for the long run. With that being said, thank you very much.